is our daily edition of Charting the Markets. My name is Lee Bowl, and I'm a trading services manager with Charles Schwab here in California. Also from California today is my friend, trading colleague, and regional investment strategist for Northern California, Lou Mercer. Morning, Lou.
Good morning, Lee Bull. I'm excited to join the show on the one and only birthday week of Lee Bull. Such an
Yes,
exciting week. How'd you celebrate, Lee?
I went to bed early.
I love it. Yeah,
All
it's going to be
righty.
a fun show today. I can't wait to get into this, especially with the volatility we're seeing on the market today.
Yeah, it should be fun. So before we get to the good stuff, though, our usual logistical items, we want to hear from you. So send in your questions in the Q&A functionality underneath the presentation window. Questions are private, want to be seen by Lou and myself. We'll keep our eye on them to make it as interactive as possible, but we can't always get to all questions due to the number of people on these sessions. We also have some written disclosures we are required to show. Everything Lou and I talk about should be considered as educational and informational in nature only, not to be construed as a personalized trading recommendation. Does sound like I've said this stuff before? Any expressions of opinion we make could change at any time based on market conditions. We look at a lot of charts in these sessions, Lou, hence our name, Charting Markets. But we
Such
do
a
not
clever
recommend,
name, Lee.
it is
Such
a
a clever
clever
name.
name. It is a clever name. But we don't recommend the use of technical analysis by any means as your sole method of investment research. We look at ETFs and ETNs to review what's going on in markets and sectors, but if you're going to trade those products, read a prospectus. We also look at futures contracts. If you're going to trade those, do read the risk disclosure document for futures and options. And with that, I'll put up the heat map a little on the red side today. We'll see why in a second. So I'll do the news here, Lou. If I missed anything, just chime in.
You betcha.
Alrighty, so the first little negative news started when the announcement came out the U.S. is weighing new tariffs on $3.1 billion of imports from France, Germany, Spain, and the U.K. So they're both increasing existing tariffs and adding new tariffs. The new tariffs are on olives, beer, and gin. So it's from having gin martinis, that's not the best. And they increased tariffs on aircraft, cheese, and yogurt. Also, they said that they are going to extend the ban on visitors from America in the EU because of our unfortunate virus situation here. Keep in mind, Europeans are still prohibited from entering the U.S. as well. We had a little bit better news, though, in some of the sentiment surveys here overseas. The French National Statistic Agency updated business confidence numbers. It showed that they recovered 50% of their decline since the start of this whole pandemic thing. The numbers are still pretty grim, but at least there is recovery coming on. And then Germany, we had the IFO numbers. They showed that business expectations are now equal to where they sat in February before the big market decline. So they have fully recovered now from the drop, in March and April. Less sanguine news, though, from the IMF. They slashed their economic forecast once again and warned that public finances will deteriorate significantly as governments attempt to combat the fallout from the virus. They are now estimating a contraction of 4.9% in global GDP. Their previous estimate back in April was for 3% decline, so that's quite an increase. Quote here, the COVID-19 pandemic has had a more negative effect on activity in the first half of 2020 than anticipated, and the recovery is projected to be more gradual than previously forecast, unquote. They also dropped their GDP forecast for 2021 as well from 5.8% to 5.4%. Speaking of the virus there, Dr. Fauci yesterday said that COVID-19 trends were, quote, disturbing, unquote. The U.S. recorded 25% surge in new infections for the week ending June 21st. 10 states have had increases greater than 50%. Now, a lot of that is increased testing, but the test positive rate, like in Florida, went from 10% of tests that were done, that showed positive results to 15. That's a 50% increase. Also, just over the wires, if you want to go to New York from Alabama, Arkansas, Arizona, Florida, North Carolina, South Carolina, Washington, Utah, and Texas, if you go to the Big Apple, you have to self-quarantine for 14 days before you can go out in public.
Yikes.
So
Yeah,
that's not
let
good.
me tell you a quick story, Lee. A
Yeah.
friend of mine is a waitress, does a lot of art jewelry, but is also a server at a restaurant in California. And the busboy at the restaurant tested positive for COVID-19. So the management staff of this restaurant, and keep in mind they have a couple locations, they said, well, you can go ahead and continue to work if you want, or you could go get tested. But if the test comes back positive, we're going to ask you not to come in and you won't be paid.
Ugh.
So this is something that we don't want to hear as consumers, right? We don't want to know that
Right.
someone's given the choice of either continuing to work and pretending like you did not work with the person that was positively tested,
Right.
because you're afraid that you're not going to get paid if you don't go into work. So yikes, this is not what we want to hear.
No, so the market, of course, had been shrugging off the virus until now it isn't. So domestically, no real news. I mean, we did have the applications for home purchase mortgages were down week over week, but they had quite a spike last week. But they're still up versus 2 weeks ago, and they are up 17.4% year over year. But there's no other major economic data domestically today. All right, let's do our quick commodity review. So gold here, we've been saying it's in a range. That's what it is. We talked yesterday, Lou, I don't know if you caught yesterday's, but we looked at some back testing data that said when gold and the NASDAQ make new highs together, it's very unusual. And it was slightly negative going forward for the next month, both on the NASDAQ and for gold, for what it's worth.
Oh,
So,
interesting.
yeah, so we are right at the top of the range. If you want to go long, I would wait for a breakout. Well, I don't know. What do you think? Or you could short it with a target of at least the midpoint of the range. What do you think?
Yeah, wait for a breakout, either the initial breakout or wait for it to form a triangle. So in other words, it breaks out, it runs up for a couple of days, comes right back to that light blue dotted line, retesting the previous resistance, which would be support. But that's an 8-year high, or pretty darn close to an 8-year high on gold there.
Yeah. So, yeah. So, yeah, definitely that's what we want to see there. Again, it is from the back testing perspective, it's not the most positive that it made the high with the Nasdaq. Let's take a look at this one now, Lou. This is an inside joke,
The
everybody. So
doctor. Lee, why do they
yeah,
call this the doctor?
good question, Lou. You ask that pretty much every time, and the answer stays the same. It's because some people consider it has a PhD in economics. All right. Well, anyway, the doctor has. Let's put up the overlay of the SPY, which had been giving us just a little bit of
Oh,
pause
look.
when we had this divergence where copper went down and it's up, but it did seem to, you know, kind of reverse itself. You'd still have to say though that copper uh, has supported the move here on the market, and at this stage though, to go long again, if you aren't already long, you're probably going to look for the 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 breakout.
And this looks like a pretty strong resistance there at that
Yeah.
light blue dotted line. Can you zoom out a little bit? Oh, you're
Uh,
actually out.
how far do you want me to go out?
Look at a full year.
There you go.
Yeah, okay. So we do see some resistance there. And then a
Yeah.
lot of people are
Also,
talking to see, can we see that $3? And you would argue that if we finally do break through resistance, that we can run all the way up to that 290 level and retest those highs.
yeah, I still think you have to be. I mean, it's certainly not a bearish chart. Also, I was looking at some research, which I didn't know that when they do this, that when they roll out 5G, that takes a lot of copper, apparently. I did not know that. So,
Oh, interesting.
yeah, so I think the fundamentals here are pretty good. Uh, at this stage, though, you might as well wait for a breakout if you're not in. If you're already in, I'd watch that. Let's just put up just the 20-day moving average as a place to do your risk. I think that's a pretty good level to watch. What we don't
Yeah, it
want to
looks like
see,
we found that not only on the upside when it was declining in February and March, but then it used it as support here in April, May, and June.
yeah, what we don't want to see, which would I think put a cramp in the stock market rally, would be now a close under 250 for a while. So
Yeah,
anyway,
so investors might use that 250 level as a tell. If we break down below that 250, that might tell us that as a leading indicator that the markets might, or growth in the markets might start slowing down.
yeah. But anyway, at least this isn't positive. Okay, let's take a look at the oil.
Lee, there's something funny. I love looking through YouTube and Google searches just to see what a lot of the talking heads and commentators were saying about different prices in history. And I found a YouTube clip from January because I remember that Goldman said something about oil costing a couple dollars off a barrel of gasoline. And the quote on January 23rd was, coronavirus could shave $3 off oil prices.
When it went down to
that's
zero.
that's when it was around 60, like $5 a barrel. They were saying it could cost $3 a barrel. Wow, always impressive.
Yeah,
Some of these
so
comments that come up.
it's Goldman Sachs. Maybe they should do Bronze Sachs instead. That's not the greatest call. Yeah, anyway, pull back to the 20-day moving average. We successfully filled the gap, though. Pretty good support at that level around 39-ish. The EIA data came out today. Uh, a little bit bearish. I think that's why you're seeing just a little bit of a pullback today. Crude oil inventories, excluding those in the Strategic Petroleum Reserve, increased by 1.4 million barrels from the previous week. That's a little bit more than analysts were expecting. If you're interested, we are still, just to show you, there is still a supply glut, although we're working through it. But the crude oil inventories right now in the U.S. are still 16% above the 5-year average, and the total gasoline inventories are about 9% above the 5-year average. So,
Yeah, and we'll look at the energy sector here in a little bit, but as a foreshadowing of what's to come, we were in a really nice rally off of those March 23rd lows in the energy sector, and we just broke through a key moving average today.
yeah, we'll take a look at that. That'll be the first thing. Just remind me, we'll do that as the first sector scan there. Excellent. Okie dokie. Let's move on to our bond signal in the TLT. So we were up earlier on the 10-year yield. We talked about, we'll talk about more when we talk about the market, about that was belying what the pundits were saying about rebalancing, but now it's dropping. Maybe the rebalancing is finally starting, rotating out of stocks to bonds a little bit, but it also could be, now that the market's down strong, again, that flight to quality, though. Anyway.
Yeah, on the 6-month chart that we're looking at here, from an objective point of view, it looks like we're still range bound. Looks now to be a false breakout there on that June 7th move higher.
Unfortunately, you're right.
And now at this point, I would go back to the green line and the blue line as a range. And we'll look for new clues, see which way it wants to go.
Yeah, let's go and take a look at the, put up the TLT here on our signal. All right, so our last trend following buy was here as the 20-period exponential moving average crossed the 50. We got a sell when it crossed here. The point in here, as I try to do with these arrows, is because the two moving averages are so close together, there's a chance you could get whipsawed a little bit. So what I suggest is look at these two levels and don't take a trade until you break one way or the other there. Because if we break higher, that'll put the cross in a positive. If we break lower, that'll make the cross a little bit more negative. But generally speaking, when you're doing moving average crosses, if they don't have slopes to them going in, as much, like you can see this, they were nice slope going in. Now they're flat. Then you want confirmation on the price action, and I would suggest that a move below 158 would be a sell signal at this point, and a move above 165 would be a buy signal. But right now, there you go.
Yeah, and that's something we get questions from all the time is, okay, how would I set up my selling strategy or my risk management strategy? And that's something that on the previous hour, Kevin Horner and John Bullock discussed on the trade management, managing risk to preserve capital. So if you missed that, keep an eye out for it in the calendar, managing risk to preserve capital. They did a great job really talking through different order types to protect yourself, like stop limits and trailing stops.
Yeah. All right, let's turn our attention to the market. And I know that you've got some interesting insights there. So I'm going to turn over to you for a little bit.
Yeah, so I just mentioned earlier that I love going through Google and listening to old quotes just to kind of poke fun at the people that made the quotes, or see, okay, maybe I'll dissect this a little bit further. And this reminds me of something that Mr. Warren Buffett said on May 6, 2019. You could find this if you just search Google quite easily on the CNBC website. But he says, I think stocks are ridiculously cheap if you believe that 3% on 30-year bonds makes sense, right? And if you take a look at where the 30-year bond is today, it went from 3% down to about what, 1.7, 1.9, somewhere in that camp, 1.45.
40. Yeah, 140.
So
yeah.
If in May of 2019 he was saying that stocks were ridiculously cheap at 3% on the 30-year, well, at a 1.45 30-year, maybe stocks are not as expensive as we think.
Interesting. You also had some notes from something to one of our fine competitors, Fidelity. What's going on over there?
Oh, yeah. So there is, let me find this here. There is something that we found. I was taking a look at Twitter the other day, and Fidelity actually published a little chart here to show what percent of people over the age of 60 sold stocks. And I don't have it exactly in front of me, but it's something like 30% of all of their investors above the age of 62 sold all of their stocks between February and May.
Well,
Think
I
about
have
that.
as young people.
Yeah, so as people had less time in retirement, people are starting to get more nervous. Behavioral influence come into play. And people that were taking a more aggressive approach to a portfolio, they just finally kind of washed their hands and said, look, I want no part of this. So if you look at where the market is now, how it keeps climbing, I understand today's a down day, but just about everyone I talk to still in person tells me that they're afraid of the market. Why would they invest now? They can't believe it's going higher. And if you think about all these people that move to the sidelines, you got to be right twice, when to get out and when to get back in. And it's not as easy as we.
Absolutely. All right, I've got some interesting data here on the market as well. So first, though, I'm going to take everything off the chart, and why don't you just tell me what you want to put on, what levels you are looking at, where you see support and resistance. What do you want me to start putting on there for you, Will?
If you don't look at news at all, and you
Right.
take a look at this one-year chart on the S&P 500, I'm going to ask you, is it going up, is it going down, or is it going sideways? Now, time frame really matters. By looking at this one-year chart, and if you look at the March 23rd lows all the way up to where we are today, I would just draw a trend line at those higher lows and higher highs. Just simply, roughly, right? We're just guesstimating when this uptrend may end. And I would look at today's sell-off as an opportunity, Many traders would look at this sell-off as an opportunity. It's telling us it wants to go higher, right? I know that we might not want to believe that it should or could go higher, but this shorter term or intermediate term trend is higher, and I would stay the course, just come up with some type of walk away on the S&P and all the other major indices. So what's
Yeah.
great about the S&P is you could actually play it two ways. One, we're looking at this uptrend, but you could also draw lower highs if you just connected the February high there to that May high. So someone might also play it this way, and therefore it's a real easy short, because if you're wrong, you find out you're wrong fairly quickly, you risk very little, and you give yourself a chance to go down and retest some of those lows.
Yeah, so I think you know, first level on a horizontal basis is there's a whole area of support between 2775 and 3000 basically. This range in here. Then of course you gotta know where the 200-day is. Interesting how the tail today was right at the 200 and they bought it up.
And that 50 looks like something that's
Yeah, I mean, so I mean, if we took
that you
out
could
the,
trade against.
yeah, if we took the 200 out, you know, then you got this area of support in here. As you know, my viewpoint here has been that longer term, you know, 6 months to a year, probably positive. I've said we're probably going to be weak for the numerous back testing studies that I've shared with all you. We're going to be weak maybe for the next month or so, or at least range bound. I think that's what's happening. But I want to go over the market narrative here too, just a little bit. So the narrative is that there's $75 billion of potential rebalancing out of stocks and into bonds from how pension funds are allocated. Now, we talked earlier, and that's not, I mean, 75 billion is a lot of money, but remember the market capitalization is about 34 trillion. But still, we might be seeing that. We didn't see it this morning, but now that the bond prices are going down, up, the yields are going down, maybe we're beginning to see this. But the question is this end of quarter rebalancing, can you get any clues from it? And if you look at all quarters, going back to 1995, there isn't really any historical correlation between quarter end and how the market does, with one exception. And we are probably seeing that exception now. If the S&P, okay, up to the last week of the quarter had been an exceptional quarter, either exceptionally bad or exceptionally good, then there is a correlation. And
we were on one of the strongest quarters ever. And in fact, before today, we were looking at the strongest quarter ever.
That's right. So here is something interesting. So if the S&P had rallied more than 15% up to the last week of the quarter, which is obviously the situation we're in now, then the last week was only up 43% of the time, with a median return of 0.2%. And that's fairly weak given the overall positive bias in the market since 1995. So theoretically, if investors are rotating out of stocks near the end of good quarters, they should be rotating into bonds. And there was some evidence of that, because on those big up stock market quarters, during the week that the rebalancing comes in, which is this week now, the Barclays US Aggregate Bond Index was up 81% of the time in that week, and a return of 0.4. So there is, if it is a major move, then you do get this rebalancing going on the last week. So you might ask, well, what happens if it was a really lousy quarter? It is the same thing in reverse. If you have a really negative quarter, in other words, where stocks are really getting hammered, then there was a pretty strong bullish bias for the stock market during the last week as they rotate out of bonds into stocks. And again, the data from Barclays supports that because the bond market was only up about 60% of the time versus 81% of the time when the first quarter was up. So there is a little bit of negative bias right now from the rebalancing narrative.
And Leah, a question that I have, and looks like John has it in the sunshine state as well. Why do they wait till the end of the quarter? Why wouldn't they rebalance before the end of the quarter? Seems like too many people would know that you're rebalancing and then try to front run what you're doing.
I don't know. That's a good question. I don't know. It just, but the statistics are what the statistics are.
Yeah, that's what
you know.
everything I read says the same thing.
Yeah. Now, here's another interesting chart I'm going to show you.
Dun, dun, dun.
Dun, 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 dun. All right. I got to explain this one to you, but it is very illuminating. Okay. So, what are these lines? So, what I've done here, okay, and this is based on some other research I read, and I tried to basically do it myself to see if they were correct, and they are. What is this chart? So here is the theory. If you are more in a speculative market, then typically you get a more volume kind of in the NASDAQ than you do in the S&P, relatively speaking, right? I mean, I think we can, because the more speculative stocks are in the NASDAQ composite.
Yep.
I think we'd agree on that, right? So what this is the ratio of NASDAQ volume to S&P volume. I have that invisible. You can't see the actual ratio. What I did, though, is then plotted the 50-day moving average of that ratio of volume and compared it to the 200-day ratio of that volume. And notice how far we are apart, right? Every time we have gotten this far apart, which means there's a lot of speculative activity, sometimes it just goes more sideways, but sometimes it does lead to a correction. Just showing that this is a way to look at that speculative excess. So we had it here in 2001. We had it in 2005. Now there, the market just went sideways, but it didn't go up. And then, of course, we had it right before the swoon in the last part of December in 2019. And we had it again right before the highs in February. So this is just adding to the narrative that I feel, again, shorter term weakness, maybe longer term strength. Longer term strength because of all of the breadth signals that we have seen over the past few weeks, few months. So that is just, again, maybe just a little bit of a warning sign. Now, speaking of that, we have Anna in Colorado wants to see the McClellan summation. I don't know which one you want to look at. We'll look at both of them. So a lot of people look at these. The McClellan indices basically are momentum measures of the advance to decline line. Okay, so let us take a look at first the overall, just the McClellan oscillator itself, and that switched to negative a couple of days ago, 3 days ago. This is, and you can see, well, when it goes from below zero to above zero, generally that's led to rallies, right? When it drops below zero, sometimes it, here it didn't really give you much of anything. When it went back above zero, it did give you some. And we're below zero now. Just when it's below zero like this, it can lead to either sideways or um, that. Then we have the McClellan Summation Index, which is just the running total of that. And this gives you longer term, less frequent signals. There's two people the way to do this is when you go from below zero to above zero, again on this, these are the buys I have with green lines. And when you drop below zero, those are the red lines. So the other way that some people use this is that a buy signal is when you get above positive 500 and a negative signal when you drop below positive 500. But the longer term situation here does reflect the those breadth thrusts that we've been talking about. Now, the other one that people want to see, which we'll do it, is the McClellan Bollinger Band signal based on the VIX. And this has not triggered yet one way or the other, okay? What we look here is this is the VIX, okay? And then we look at the slope of the upper Bollinger Band with a 50-period moving average, one standard deviation setting versus the normal setting. And I didn't come up with this, but he did. And I look at it all the time. When that turns down, that slope, it's a buy signal. When it turns up, it's a sell signal. Not too bad, right? If you look at the signals over the last couple of years. So this has not triggered a sell yet by any means. So this is still in a longer term buy at the moment, but it is flattening. So that's something to keep an eye on. The other level I'm looking at with the VIX is, I pointed this out before too, and I got that red line right in there. You'd feel a little bit better if the VIX could drop back below 25. Because every time it's got down there, right, then we've had a spike back up and the market tends to sell off a little bit. So it would be nice to get back down below that, which we have not been able to do since the beginning of March. So,
Hey, Lee, have you ever thought about coming out with your own indicator?
no. So maybe I will. Who knows?
Yeah, I tried to come up with a board game or a drinking game one time, and I came up with about 8 ideas. They were all bad, but
yeah.
I
The
knew
only
that
thing I
there
was
might be a
thinking,
way to
the only thing I was thinking of, maybe I could say Bollinger Bands as opposed to Bollinger Bands. That's the only one I thought of. Okay. So can you identify which bonds they are rebalancing into? Well, yeah, generally especially the pension fund balancing, they're going to go both into investment grade corporates and treasuries. They're not going to go into junk.
Yeah, and if you look at a ETF like BND, the Vanguard BND, and then you just take a look at the portfolio, that gives you a pretty good idea, without the dollar sign there, Lee. That'll give you a pretty idea of what style bonds are in the bond universe and percentages. So
yeah, you can take a look at that. All right. Let us take a look at the NASDAQ.
yeah, and then Lizanne actually just put something out on the NASDAQ talking about how many stocks are above their 200-day simple moving average. And out of the, if we take a look at the entire NASDAQ, 2,600 or so different stocks, there's only about 1,100 that are above their longer term 200-day simple moving average.
Yeah.
On the chart, though, this is a beautiful uptrend. Someone wrote in earlier, Warren Buffett once said, I realized that technical analysis didn't work when I turned the chart upside down and didn't get a different answer. What do you make out of this statement? And what I love about technical analysis is not for my longer term investments, right? Longer term investments are all about diversification, staying the course. Don't let the behavioral characteristics that might influence you. But for trading, everybody needs to figure out where to get in and where to get out. I find that looking at supply and demand on the chart is a great way for you to predetermine your exit strategy on a trend. And it helps me keep my emotions on the sideline and not come up with different excuses on why what we're seeing happening shouldn't or can't happen. And the NASDAQ is a perfect example. The reasons behind it, who knows? We'll definitely know in the future at some point. But this is a beautiful uptrending with higher highs and higher lows. I think what she's saying, though, is just a warning of there's not a lot of strength from everyone involved here. Looks like just the biggest stocks.
Yeah, so close, of course, below that 20-day moving average would be a slight negative in the short term. But it's very interesting that it didn't even get down there. They bought it right at support, at least for now. But again, my feeling is we'll have some choppiness, maybe do a slightly lower bias for the next couple weeks, maybe. But there we go. So
Lots of happy birthdays coming for you, Lee. We finally got to your birthday week here in 2020.
yeah,
Maybe you're like the rest of us, and hey, we'll just skip 2020's birthday.
I
But
think so.
I'm glad you got to celebrate. Somebody says, do you think today's dip makes sense to buy from a risk reward ratio? And
Depends on your time frame. It depends on what you're looking at. But I mean, you
better
got
than
very
yesterday.
yeah, you got real let's go to an hourly chart, or at least you know, there's a level for you on the cues in the short term, right?
Yep.
You
We
you
give
can
it a
see it.
little bit of cushion on that blue line, but yeah, the idea would be if we break below that support point, that yeah, we probably will try to retest those June 15 lows
Yeah,
down at around
but we
232
haven't done it yet. So again, if you don't, look how they bought it right up there. You could set risk to reward right now for a real short-term trade, just to stop under this. No, you probably put it under those lows right there, and maybe it'll go back to the high. So from a risk to reward, maybe there. Let's just look at the Russell real quick, and then we've got to do our sectors because I know you want to talk about energy. So let's go to the daily here. So this is certainly the weakest. Looks like the 20-day is now acting as a cap. Wouldn't surprise me if we pulled down and tested the 50-day here, which is also coincident with that last sell-off that we had back in the middle of June. All right, you wanted to look at energy, so let me put up there. I'll turn over to you, Lou.
Yeah, just for fun. So energy is something that the Ned Davis chart of the week discusses. And the point they're trying to make with energy is they're surprised to see how much of the total return on energy has actually come from dividends. You would expect a big chunk of total return to come from dividends on sectors like financials and sectors like utilities. But what was surprising to them is energy tied real estate investment trusts with a percentage of total return coming from dividends. And that was 40% of the 20-year total return on energy came from dividends. They're saying that they believe dividends will continue to represent a large portion of energy's total return, and stocks with sustainable dividends, right? Sustainable being the key, will continue to outperform. So from those March lows, and actually energy bottomed just before the March 23rd lows. I believe the entire market bottomed on March 23rd. But nonetheless, we were in this beautiful uptrend from that point, higher highs and higher lows. And today could be a key level. So that purple line is the 50-day simple moving average. That's a key intermediate term support line that traders may use. And that's something that as we close below that yellow line, that might be a spot where traders look to exit.
In the short term.
Yeah, capture some of those gains maybe they were in.
Yeah, for sure. You do have decent support though on around 35.5. Somebody want to look at the oil services? Let's do that. We saw yesterday when somebody asked about the oil services, does it correlate to the price of oil? We saw, yes, it does. So now, what are we doing? We are trying to fill this gap. We could move this down a little bit to the, so
Casino
No.
stocks and airlines and a lot of these near bankrupt companies are the ones that have high risk. Just be careful trading or investing in them. Potential reward means high risk. I've been talking to investors that have been nibbling in this space, and a lot of them don't really have any type of exit strategy. So just make sure that you know, are you long-term investing or are you shorter-term trading? If you're shorter-term trading, hey, it's great to take a profit if it goes up, but please try to think about where you're going to sell it and take your loss if it goes against you. What we don't want to hear is taking a small profit if it goes up, but hanging on to it if it goes down. And in a lot of those sexy names, those Davey day trader names, people are getting into them without a solid plan. So do be careful.
Yeah. So we can see that nothing is really up, but holding up better. Solar here, rare earth, gold miners a little bit. Let's see what is getting really whacked. Yeah, this one had been on a tear. This is the based on the dry shipping rates. So I guess they're getting a little bit of headache maybe from the virus coming back. To your point, though, Lou, airlines, these reopening stocks are taking a little bit on the chin, obviously. And we got the banks not doing well, which is no surprise now given the drop in the 10-year yield.
Yeah, I'm surprised the banks sold off as much as they have, with the 10-year really just kind of going back to that range that we looked at earlier.
Yeah. However, risk to reward wise, again, if you're bold, you got an opportunity. The only thing that might mitigate against that is, so these are the money center banks. And I would point out, depending on how you draw this, this is a head and shoulders. So a break below the 50 would confirm. I mean, we broke the neckline a little, but the 50 is right there. But if we take the 50 out, then you're really confirming this head and shoulders, and the measured move going down, 38 to, let's say 32, 6 points, that'd put you back down to here somewhere. That hasn't happened yet, though. But look for the behavior of the banks right around where we are now. Apparently, I also was reading that they're going to keep lowering their interest rate. They don't need any more money. They are flush with money. So you're not going to see a lot of, just from a saving point of view, you probably see savings rates go down because they don't need any more money, apparently.
Yeah, and I love that head and shoulder pattern just because it's a reversal pattern. So something that was working higher highs and higher lows, we're trying to determine when that is going to stop. It's not going to get you out at the top, but it is going to help you get out of it before it might continue to move lower. Once again, we're only talking trades, long-term buy and hold. Diversification is key. We're going to talk about using exchange traded funds to diversify your portfolio at the top of the hour as we talk about strategic uses in today's market.
All righty, we got a question. Do you subscribe to the uptrend 4 days before July? Well, let me just give you, I'll answer this one question and then we'll go. So I'm looking at data from 2000 until now. If you want to know, generally speaking, okay, the day before the July 4th holiday is negative. However, the 2 days before, it's been positive 80% of the time, but the day before July 4th holiday is only up 30% of the time. Where you do see the bullish bias is the next 3 days after the July 4th holiday. So those are your data points.
And going back to 1933, Lee, on the seasonality workshop that we put together here, the average 6-day return. So if you bought 3 days before Independence Day and sold 3 days after, that average 6-day return is 0.83%. which makes it the best 6-day period around a holiday, aside from New Year's, Christmas. But Independence Day would be number 3 there.
Right. So if you were going to use the data that we just gave you, you would probably buy in the afternoon of the day before and sell 3 days after, maybe. All right, that's it. So again, as Lou said, he's up next. Strategic uses of ETFs. Thank you very much for your kind attention, and take care.
Thanks. Bounced a trade idea off my firm. They don't get it.
Schwab shows you indicators, proprietary research, helps you see the full picture.